Next, let's go over the operational considerations when you are pulling consolidated financials together. So one thing is, how do you account for each individual legal entity? Since Parent Incorporated has ownership in 100 LLC and Sub LLC, on the Parent Incorporated's own books, their legal entity books, they are going to have investments in those two subsidiaries. So if we look at the balance sheet here, you'll see there is an investment in Sub LLC and there's an investment in 100 LLC. This is equity method accounting. So in Parent Incorporated's books, they are rolling up the earnings or the net income related to these two subsidiaries. Equity method accounting on the parent side, they are recognizing their pro rata portion of earnings from the investment. So 100 LLC, they're recognizing 100% of the income related to that entity. And Sub LLC, they're recognizing 75% of the income. And you'll see this here on the income statement. Income statement is where the equity income, that is the pro rata portion of earnings or net income related to ownership in the subsidiaries. So you'll see equity income of 100 LLC, go down to the net income of 100 LLC. You see it's 90, so since it was 100%, it's going to recognize $90,000 of net income or equity income. And they are also recognizing 75% of the net income related to Sub LLC because it has a 75% ownership. Now that is just for legal entity Parent Incorporated. We are going to eliminate all this activity when we roll up the two subsidiaries into the parent for the consolidated financial statements. So journal entries related to equity income. So in this situation, we're just going to recognize the subsidiary's income. I'm just going to go through the entries. Equity income for the investment in the both subsidiaries. This is from Parent Incorporated's books. Since Parent Incorporated owns 100% of 100 LLC, they are going to recognize a $90,000 increase in the investment. That's the debit. And then the credit is $90,000 of equity income. Basically, their investment generated $90,000 of net income. And from a legal entity standpoint, they have a line item of equity income, 100 LLC, $90,000, and you'll see that on Parent Incorporated's income statement, ignoring the consolidated effort and all the other entities. Exact same concept with Sub LLC, except we don't own 100%. You're only going to recognize 75% of the net income. So I'm going to take the 330 times 75%. That gets me $247,500. That's going to be a debit to my investment in Sub, and then a credit to Sub LLC equity income, and you'll see that on the parent's income statement as equity income from Sub LLC, $247,500. So Parent Incorporated, just from their legal entity standpoint, is recognizing the net income of the ownership related to the subsidiaries that they have a controlling or a financial interest in. Another part with equity method accounting, let's say one of those entities declares a distribution, a dividend. In that situation with equity method accounting, that dividend or distribution is not revenue. It actually reduces your investment on the balance sheet. So let's say you get $50,000 from 100 LLC. That's going to be a debit to cash because you got the money, and then it's going to be a credit to the investment in 100 LLC that's sitting on the balance sheet, which will reduce your cost basis or your basis in that investment. Same thing with Sub LLC. They sent you $75,000. Let's say they declared a $100,000 distribution. You own 75%. You get $75,000. It's going to be a debit to operating cash and then a credit to investment in Sub LLC. That's some basic equity method. I wanted to go over that because when you're recording your activity related to the subsidiaries, you need to keep in mind of what the parent's ownership is in that subsidiaries, because from a legal entity standpoint, Parent Incorporated still needs to keep their books intact, even though they're eventually going to consolidate all these entities in this example. A lot of times a organization will define an entity that pays all the bills, pays all the payroll, and then they will allocate those expenses out to the other entities. That doesn't happen everywhere, but at least in my experience, there's always been a paymaster, a primary entity that pays for everything, which leads to this next subject, which is intercompany accounting. when you have entities that are transacting with each other, it creates intercompany payables and receivables. Parent incorporated in our situation pays payroll for all the other subsidiaries. But 100 LLC actually has employees that should be allocated to that entity. So technically, those employees are on Parent Incorporated's payroll, but we are going to use this. We're going to go through the journal entries of how to allocate that payroll expense to 100 LLC from the payroll, leaving the operating account of Parent Incorporated. So let's just use a nice round number of $25,000. From Parent Incorporated standpoint, they paid $25,000 of payroll expense related to an employee that's of 100 LLC. So from Parent Incorporated standpoint, they have paid payroll that will be allocated to 100 LLC. So from Parent Incorporated standpoint, their journal entry for $25,000 of payroll expense is to debit the intercompany receivable from 100 LLC and then credit operating cash. The cash went out the door to cover the payroll, and now 100 LLC owes Parent Incorporated $25,000. Now, from 100 LLC's books, from their standpoint, they have $25,000 of payroll expense that's going to go on the income statement, and now they have an intercompany payable to Parent Incorporated, which is a due to, or they owe money to Parent Incorporated for the payroll that they paid. That is Parent Incorporated being the paymaster in this situation, and 100 LLC receiving an allocation from Parent Incorporated. So how does Parent Incorporated get paid back for that $25,000? So 100 LLC, let's say they have $25,000 in cash, they would then pay back Parent Incorporated. It's kind of the reverse journal entries here. They are going to send it. They're going to send $25,000 to Parent Incorporated. They're going to debit operating cash when the money hits Parent's cash account, and then they're going to credit the intercompany receivable from 100 LLC, and then from 100 LLC's books, they are going to debit the intercompany payable to Parent Incorporated. They're paying back the $25,000 that was allocated to them, and they're going to credit cash for the transfer of money to Parent Incorporated. That is how intercompany activity can arise and how it can be settled when you have multiple entities transacting together, and you have, especially if you have a paymaster in that situation. With intercompany relationships, there's some other considerations that you want to have. One, since these are totally separate legal entities, even though they might be owned 100%, there should be some sort of agreement between the two entities on how the money gets paid back from multiple reasons. From a legal, from a tax perspective, you want to have these intercompany agreements between the entities, especially if you have multinational or non-U.S. entities that you're consolidating. You really want to make sure you have your operating or your intercompany agreement with that entity outside the United States, just because not only are you taking into consideration of U.S. tax law or laws in the United States, you also need to take into consideration the laws of the country that you're also operating in. The last consideration before we just start pulling these financials together is these entities, if they generate profits and they're not paying back intercompany activity, they can dividend or distribute up those earnings to the parent. And in that situation, the journal entry is going to be debit distributions, which is an equity, and then credit cash for any dividends or distributions that have been paid to a parent.